$209 billion. That's how much Silicon Valley Bank controlled on Tuesday, March 7, 2023. By Friday morning, it was dead. In 48 hours, the 16th largest bank in America imploded in the second biggest bank failure in U.S. history. Customers tried to withdraw $42 billion in a single day, nearly a quarter of all deposits. The next day, another $100 billion was queued for withdrawal. The bank woke up Thursday morning solvent. By Friday, it had a negative cash balance of $958 million and couldn't meet its obligations. This wasn't a slow bleed. This was a full-speed collision with reality. Half of all venture-backed tech and healthcare companies in America banked here. Names like Airbnb, Fitbit, Pinterest, Cisco. When SVB died, payroll froze for thousands of startups. The FDIC had to backstop $20 billion in losses. 3 other banks collapsed in the aftermath. Here's what killed them: a CEO who lobbied to weaken his own regulations, a missing risk officer during the most dangerous period in decades, a bond portfolio that lost billions when interest rates spiked, and a tech community that turned on them in minutes. Every mistake, every warning sign ignored. Let's go back to where it started. Silicon Valley Bank wasn't supposed to end like this. For 40 years, it was the bank that understood innovation. Founded in 1983, SVB solved a problem no one else would touch. How do you lend money to companies with no revenue, no profits, and sometimes just an idea on a napkin? Traditional banks laugh these founders out the door. SVB bet on them instead. The pitch was elegant. You need a loan? Sure, but you must bank exclusively with us. Every dollar of your venture funding, every payroll account, every line of credit. We get the relationship. You get a partner who understands your world. It worked spectacularly. By 2011, when Greg Becker became CEO, SVB was the preferred bank for the entire innovation economy. Becker himself embodied the dream. He'd started as a loan officer in 1993, lending $350,000 to a company Cisco later bought for $100 million. He climbed through the ranks, launched their venture capital division, understood both sides of the table. The bank's model was simple but powerful. Tech companies raise massive equity rounds from venture capitalists. They deposit that cash with SVB. The bank loans back a fraction for operations and invests the rest in safe securities to earn returns. When companies succeed and exit, everyone wins. Then COVID hit, and winning became absurd. From March 2020 to March 2021, deposits doubled from $62 billion to $124 billion. Tech companies were suddenly drowning in funding. Interest rates were near zero. Venture capital firms were writing checks faster than startups could spend them. Every dollar flooded into SVB. Becker and his team faced a golden problem. What do you do with an extra $62 billion when interest rates are microscopic? They chose long-term treasury bonds, 15, 20-year securities paying barely above 1%. The returns were modest, but the bonds were backed by the U.S. government, supposedly the safest bet in finance. By late 2022, SVB managed $117 billion in bonds, $91.3 billion marked, held to maturity, and $26 billion available for sale. The held-to-maturity designation was crucial. It meant SVB didn't have to report losses on those bonds as long as they held them until they matured. On paper, everything looked stable. Becker's reputation soared. He chaired TechNet, the premier tech trade association. He sat on the Federal Reserve Bank of San Francisco's board, literally helping oversee banking regulations. He led the Silicon Valley Leadership Group. Forbes named SVB one of the world's best banks in 2023. Behind the scenes, he was also lobbying hard. In 2015, Becker testified before Congress that banks under $250 billion didn't need strict oversight. He called enhanced regulations unnecessary compliance measures for institutions with SVB's low-risk profile. When Trump signed the Economic Growth, Regulatory Relief, and Consumer Protection Act in 2018, the threshold for strict oversight jumped from $50 billion to $250 billion. SVB, at $209 billion, slipped under the radar. The bank grew fat, comfortable, and convinced of its own sophistication. They were the smart money in Silicon Valley. They understood risk better than regulators ever could. They were catastrophically wrong. The first crack appeared in April 2022, though few noticed. SVB's chief risk officer stepped down. In any normal bank, this role is critical. The person tasked with spotting dangers before they become disasters. SVB didn't replace her for 9 months. During that gap, the Federal Reserve launched the most aggressive interest rate campaign in 4 decades. This should have been an emergency. Instead, SVB operated without its risk sheriff while the entire financial landscape transformed beneath them. Here's the problem they missed. When interest rates rise, bond values fall. It's inverse math. A bond paying 1.5% looks attractive when new bonds pay 1%. But when the Fed cranks rates to 4.75%, that old bond becomes nearly worthless. No one wants a 1.5% return when they can get 4.75% next door. SVB's $117 billion bond portfolio was hemorrhaging value throughout 2022. There are $91.3 billion in held-to-maturity bonds. Unrealized losses piled up. They didn't show on the balance sheet because of accounting rules, but the damage was real. If they ever needed to sell those bonds early, the losses would become devastatingly actual. Meanwhile, their depositors were bleeding cash. The tech boom was over. Venture funding dried up in late 2021. Suddenly, startups weren't raising easy money. They were burning through their reserves to stay alive. They needed their SVB deposits. Withdrawals accelerated through Q4 2022 into early 2023. The Federal Reserve noticed. In November 2021, Fed supervisors warned SVB about interest rate risk. By September 2021, examiners identified significant deficiencies, but they waited nearly a year to downgrade the bank's rating, claiming they needed to gather sufficient evidence. SVB received formal citations, 6 of them. They failed to fix any. By July 2022, they were placed under full supervisory review. In autumn 2022, Fed officials met with senior leaders about their ability to raise cash in a crisis. The bank's models were flawed. They wrongly believed rising rates would increase revenue enough to stabilize finances. But here's the strangest part. SVB remained well-rated. In August 2022, they still held a 2 rating, the second highest possible score, for liquidity and capital adequacy. Regulators knew about problems, but kept saying everything was manageable. Becker was sitting on the San Francisco Fed's board during this period, the very institution supervising his bank. Fed officials considered removing him as the bank's ratings deteriorated, but worried about sending market signals and betraying supervisory confidentiality. So he stayed. The regulatory paradox was complete. The CEO, who lobbied to weaken oversight, was helping oversee the regulators who weren't aggressively supervising him. Then came the crucial decision. With the chief risk officer position finally filled in January 2023, SVB faced a choice. They could sell some bonds, realize losses, and reduce their exposure. Or they could wait, hoping interest rates would drop and deposits would stabilize. They waited. By February 2023, short sellers began circling. The market was waking up to SVB's vulnerability. Moody's informed SVB it was considering a double downgrade of their credit rating. The unrealized losses were too large to ignore. On February 27th, Becker sold $3.6 million in company stock, his largest sale in years. The transaction was legal, filed properly through an executive trading plan, but the optics would later prove damaging. By early March, SVB's position was untenable. They had $151.6 billion in uninsured deposits, 86.4% of their total. Their bonds were underwater by billions. The tech community was withdrawing funds faster than they could manage. And unlike 2008, information moved at Twitter speed. Everything was connected. One tech founder tells another. VCs text their portfolio companies. Someone posts on social media. Within minutes, hundreds of companies know there might be a problem. The bank wasn't broken yet, but everyone in Silicon Valley was watching. And the moment SVB showed weakness, the stampede would begin. Silicon Valley Bank announces it sold $21 billion in securities at a $1.8 billion loss. They're raising $225 billion in fresh capital, $500 million from General Atlantic, the rest from a stock sale. The market reads this instantly. SVB is in trouble. Why would a healthy bank need emergency capital? Why sell bonds at a massive loss unless you're desperate for cash? The announcement is supposed to project confidence. Instead, it screams panic. Within minutes, the stock begins falling. By the time markets close, SVB shares have dropped 60%. That evening, Moody's downgrades SVB. The timing couldn't be worse. The downgrade amplifies the fear already spreading through Silicon Valley. On Wednesday night, the texts start. VCs message their portfolio companies. Pull your money from SVB. Do it first thing tomorrow morning. Peter Thiel's Founders Fund instructs all portfolio companies to withdraw funds immediately. Coatue Management follows. Then Union Square Ventures, Founder Collective. These aren't small players. These are the kingmakers of Silicon Valley, the firms whose opinions shape the entire ecosystem. One VC later admits, this was a hysteria-induced bank run caused by VCs. This is going to go down as one of the ultimate cases of an industry cutting its nose off to spite its face. But when you have uninsured deposits, millions or tens of millions beyond the FDIC's $250,000 protection, you can't afford to be the last one out. The math is brutal. First movers get 100% of their money. Last movers potentially get zero. By Thursday, March 9th, morning trading in SVB stock is halted before markets open. The stock has already plummeted another 60% in pre-market trading. By 9:30 a.m., the bank run is fully underway. Companies across Silicon Valley are initiating massive withdrawals. Not thousands of customers making small withdrawals, hundreds of companies pulling millions each. Founders Fund withdraws all its deposits by morning, every cent, and by Thursday afternoon, SVB CEO Greg Becker holds a conference call with customers. He tells them to stay calm. He can't promise this will be their last capital raise. His voice doesn't carry conviction. Customers on the call describe it as the moment they knew SVB was finished. One investor who defended SVB that morning, urging his portfolio companies to keep their money there, watches in horror as the bank disintegrates. "I thought they were well capitalized," he'll later say. "I was wrong." The withdrawals accelerate. Every ping, every notification, another company pulling funds. The numbers climb from millions to billions. SVB scrambles to find cash. They try to move collateral from various sources. They contact other banks about emergency funding. They call the Federal Reserve. nothing works fast enough. By 5:00 p.m., customers have initiated withdrawals of $42 billion in one day. The bank's cash balance, negative $958 million. Federal regulators stay up working. The FDIC, the Federal Reserve, the California Department of Financial Protection and Innovation, everyone knows what's coming. Another $100 billion in withdrawal requests are queued for Friday morning. If the bank opens tomorrow, they'll face total withdrawals of $142 billion, 81% of all deposits. There's no way to survive that. Even if SVB sold every bond at a loss, liquidated every asset, they couldn't produce that much cash fast enough. The regulators calculate SVB is already insolvent. Opening Friday would just make things worse. By Friday, March 10th, before market open trading in SVB Financial Group stock is halted, it won't resume. At 7 a.m. Pacific, the California Department of Financial Protection and Innovation announces they're taking control of Silicon Valley Bank. The Federal Deposit Insurance Corporation is appointed receiver. SVB's 40-year run ends before breakfast. The statement is clinical. Despite attempts from the bank, with the assistance of regulators, to transfer collateral from various sources, the bank did not meet its cash letter with the Federal Reserve. The precipitous deposit withdrawal has caused the bank to be incapable of paying its obligations as they come due, and the bank is now insolvent. Employees arrive at headquarters to find locked doors. A Brinks armored truck sits outside. Confusion turns to realization. It's over. Some employees received their annual bonuses hours before the takeover. That detail will later spark outrage. Friday afternoon. The contagion begins. Signature Bank in New York faces its own bank run. Crypto deposits fleeing amid fears of another SVB. First Republic Bank's stock plummets. Regional banks across America watch their shares collapse. The FDIC estimates SVB's failure will cost $20 billion. That's just the direct cost. The indirect damage, frozen startup payrolls, shattered confidence, paralyzed venture funding, is incalculable. From a $2.25 billion capital raise announcement to federal seizure, 48 hours. From solvent to insolvent, one trading day. From the 16th largest bank in America to history's second largest bank failure, the time it takes to send a wire transfer. Greg Becker lost everything except his freedom. He was removed as CEO immediately when regulators seized the bank. His entire executive team was dismissed. The $3.6 million stock sale weeks before the collapse triggered investigations by both the Justice Department and SEC, though no charges have filed. His net worth, once estimated at $37 million, primarily from SVB stock, evaporated. He resigned from all board positions, TechNet, the Silicon Valley Leadership Group, the Federal Reserve Bank of San Francisco. In May 2023, Becker testified before Congress. He blamed the Federal Reserve's unprecedented interest rate hikes and claimed SVB had adequate liquidity until the bank run. Lawmakers were skeptical. Senator Elizabeth Warren demanded answers about his lobbying to weaken Dodd-Frank regulations. The hearings revealed that SVB had passed stress tests and held strong capital ratios, even as the underlying problems festered. No one went to prison, no criminal charges materialized. This wasn't fraud, it was failure. Silicon Valley Bank itself found a buyer. First Citizens Bank purchased the wreckage on March 26, 2023, acquiring $72 billion in assets at a $16.5 billion discount. The 17 branches reopened under Silicon Valley Bank's name as a First Citizens division. The FDIC retained $90 billion in securities and assets in receivership. SVB Financial Group, the parent company, filed for Chapter 11 bankruptcy on March 17, with $2.2 billion in liquidity and $3.3 billion in unsecured debt. Investors lost everything. Shareholders received nothing. The depositors fared better. On March 12th, federal regulators announced emergency measures. All depositors, insured and uninsured, would be made whole. The government invoked systemic risk provisions, protecting the $151.6 billion in deposits that exceeded FDIC insurance limits. Taxpayers wouldn't bear the cost directly. Instead, banks would pay higher FDIC premiums to cover the $20 billion shortfall. The human toll was real but brief. Thousands of startups faced frozen payrolls for days. Some struggled to make rent. Others missed investor meetings or critical deals. But the government's swift action prevented mass layoffs and startup bankruptcies. 2 other banks collapsed in the immediate aftermath. Signature Bank fell on March 12th. First Republic Bank, despite a $30 billion infusion from 11 major banks, failed in April 2023, seized by the FDIC and sold to JP Morgan Chase. Together, these 3 institutions represented 3 of the 4 largest U.S. bank failures in history, all within 2 months. What actually killed Silicon Valley Bank? Not bad luck, not social media, not even the bank run itself. SVB died from duration mismatch dressed up as sophistication. They borrowed short and lent long, the oldest, deadliest mistake in banking. Their depositors could withdraw anytime. Their bonds were locked up for decades. When interest rates spiked and depositors needed cash simultaneously, the mismatch became fatal. But the deeper lesson is about regulatory capture and manufactured blindness. Becker spent years lobbying to exempt his bank from strict oversight, arguing SVB was too small to threaten the system and too smart to fail. He succeeded. The threshold jumped to $250 billion. SVB stayed at $209 billion, just under the wire, and avoided stress testing, enhanced capital requirements, and aggressive supervision. Then he sat on the Federal Reserve Board that supervised his own bank. The conflict wasn't illegal, but it was corrosive. Regulators softened their approach, delayed downgrades, hesitated to act forcefully. When they finally recognized SVB's vulnerabilities, they didn't move fast enough. 3 specific mistakes could have saved SVB. First, they could have hedged their interest rate risk. Simple derivatives would have protected against rising rates. They chose not to. Second, they could have hired a chief risk officer immediately when the previous one left in April 2022. Instead, they went 9 months without one during the most volatile period in decades. Third, they could have sold bonds earlier, taken smaller losses, and repositioned before the crisis hit. They waited too long. Here's the pattern you'll see again. Companies that lobby to weaken their own regulations rarely do so from strength. It's a signal of fragility. Truly well-managed firms welcome oversight because it validates their practices. Firms that fight scrutiny usually have something to hide, even from themselves. If you're building a business, ask, are we prepared for worst-case scenarios? Do we have checks on our own certainty? Would our strategy survive if our comfortable assumptions vanish overnight? SVB believed its own story too completely. They thought they were different, smarter, immune to old banking problems. They were none of those things. 2 days, 48 hours, one bank, 40 years old, $209 billion in assets, gone. That's how fast confidence collapses when foundations are weak.